In the world of finance, your biggest threat isn't always a competitor. Sometimes it's a sudden shift in the wind. This company built a brilliant, fully legal engine for embedded finance, connecting millions to instant credit on their favorite platforms. The growth felt unstoppable, but then all of a sudden, RBI changed the rules of the game, and this startup collapsed under a concrete regulatory wall. Its name, Niro. Welcome back to the Flop Side, the podcast where we uncover the stories of Indian startups that once soared only to come crashing down. I'm your host Priyanka, and today we have a very interesting contrast to what we discussed in last week's episode. It's another case of perfect product, perfect timing, and perfect execution. But while 𝗏𝗏 was trapped in the middle of a regulatory storm of its own making, this week's startup did everything right and legally, only to get boxed in by the watchdogs anyways. We aren't talking about a flashy app with a catchy jingle or a company that plastered its logo across every billboard. We are talking about the fintech startup Niro. Now, if you haven't heard the name, that was exactly the point. It was designed to be completely, intentionally invisible. The founders didn't want to build a brand. They wanted to build a trapdoor. They called it democratizing credit. They pitched it as a noble mission to help the massive, underserved Indian middle class get the money they deserved, all with the simple click of a button. But let's be real for a second. When you make borrowing money as easy as double tapping a photo on Instagram, you aren't just democratizing credit, you are weaponizing human impulse. And for a while, it worked flawlessly, until the invisible money machine collided with a very big, very unforgiving brick wall. Act 1. The Spark. Before we get into further details, let's understand what Niro was offering. Picture this. It's late into the night. You're lying in bed, scrolling through a shopping app. You spot something you want. Maybe a new phone, maybe a couch, maybe a flight to Goa. But your bank account is looking uncomfortably empty. And then right below the price tag, a tiny glowing button whispers a promise. Buy now, pay later. Just one click. No bank tellers judging your salary, no thick stacks of paperwork, no waiting for 3 business days. Just a tap. And voila! You have the money you needed to purchase all your wants and needs. It felt magical. This magic is what we call embedded finance, Niro's core innovation. The genesis of Niro emerged from a critical gap in India's consumer fintech landscape. The digital loan market had exploded, growing from its nascent stage in 2011 to around 2.8 lakh crores by 2021. With a projection of over 100 lakh crores by 2030, according to BFSI. However, distribution remained concentrated among bank-owned digital channels and standalone lending apps like Lending Card, MoneyTap, and CoinDCX. Further, 2021 was also when the world was coming out of a pandemic, and the way we consumed everything had fundamentally changed. We bought our groceries online, we rented houses online, we even bought cars online. This is where Aditya Kumar and Sankalp Mathur come in. They realized something crucial. Millions of people were already spending hours on platforms like Snapdeal and Quikr. These apps had incredible user trust and rich transaction data. But they were leaving money on the table by not offering credit. That's when they thought, let's quietly turn these digital storefronts into banks. The logic was bulletproof. Give Snapdeal's 200 million users instant financing right at checkout and watch conversion rates jump while average order values expand. Let quicker users finance, say, a used car directly from the classifieds, erasing the nuisance of bank approvals. Niro promised to deepen platform engagement and drive high-ticket transactions at the simple tap of a button. So pitching it to these platforms was a piece of cake. Imagine you are the CEO of a major e-commerce site. Your margins are razor thin. You are fighting tooth and nail for every rupee. Then the Niro team walks into your office and says, "We will give you a line of code. You plug it into your checkout page, and suddenly your customers can take out a personal loan right there to spend it all on your site. We handle the banks, we handle the risk, we handle the tech. And every time someone clicks that button, we split the profits with you." It was free money. It was the ultimate win-win. Niro was essentially setting up invisible, high-speed ATMs right inside the digital casinos where people were already playing. They built complex API bridges. On one side of the bridge were regulated partners like traditional banks and non-banking financial companies, or NBFCs, sitting on piles of cash, desperate to lend it out but too slow to find young digital customers. On the other side of the bridge were millions of online shoppers. Niro was the toll booth in the middle. In fact, I was thinking Niro was built like a parasite. And I don't mean that in a bad way. It's because a parasite doesn't need to hunt for its own food. It attaches itself to a host that is already eating. And Niro was doing exactly the same by embedding itself into larger, extremely popular internet platforms. The vision was a masterstroke of convenience and profit. Further, Kumar and Mathur were veterans of the lending world. Kumar had already built and sold a lending startup called 𝗙𝗵𝗲. He knew exactly how clunky, slow, and frustrating traditional banking was, completely incapable of keeping up with the internet. And Mathur complemented Kumar's profile with deep risk management experience in notable fintech ventures. Together, they possess the credibility and domain expertise to be taken seriously by both consumer platforms and financial institutions. Their founder's pitch was ambitious and dangerously simple. We will build the secret pipes. We will write the code that sits quietly in the background of your favorite apps, and when a customer wants to buy something, we will shoot your loan through pipes directly to their screen in seconds. As Kumar said in an article for Financial Express,
leveraging consumer internet platforms, engagement, distribution reach, and data, 𝗏𝗏 became an obvious path to scaling an embedded financial services lending franchise.
It was brilliant, but to truly appreciate the hubris of Niro, you have to understand the psychology of the tech sector in 2021. The prevailing wisdom was that software could solve literally any human problem. If a centuries-old industry was slow, tech would disrupt it. If banking was careful and tedious, tech would make it frictionless. Because that was the latest buzzword, frictionless. Any pause, any moment of hesitation for a consumer was considered a failure of design. And in the traditional banking world, getting a loan meant friction. Niro looked at that friction and obliterated it. Oh, and the cherry on top, Niro didn't even want to spend crores on ads or TV commercials trying to convince people to download yet another app. That was the old way. That was very expensive. Customer acquisition costs were the death of fintechs. and Niro was not just trying to survive, but gunning for being on top of the food chain. Act 2. The Illusion. Investors were mesmerized. Heavyweight venture capital firms like 𝗧𝗵𝗲 and 𝗧𝗵𝗲 Capital opened their checkbooks. They poured crores into the company. They thought they had financed the ultimate invisible money-making machine. The press releases were glowing. Niro was hailed as a revolutionary B2B2C infrastructure play. They were the sophisticated architects of a new financial era. By integrating deeply into the platforms, Niro had access to alternative data. They didn't just rely on a boring CIBIL credit score. They could see how you shopped, where you clicked, what kind of phone you were using. They fed all this into their algorithms to instantly decide if you were trustworthy. They were the unseen puppet masters of India's spending habits. So by 2023, Niro wasn't just growing, it was exploding. They had successfully integrated into the market with over 10 platforms and 30 plus lending partners. And so far, they reportedly had cumulative disbursements of over 300 crore rupees and monthly originations of over 60 crores. The growth trajectory kept climbing with even more fanfare in the following year. Niro expanded its product offerings and partnership footprint, with each partner representing access to distinct lending capacity and customer segments. In mid-2024, Niro had crossed a significant milestone of 1,000 crores in overall disbursals. As Kumar said,
3 years ago, nobody would have thought that a company like Niro could disburse 1,000 crore of credit through platforms like NoBroker, Housing, Snapdeal, and ShareChat. From a distribution perspective, no other fintech has been able to build distribution to such a large base in such a short time.
They were generating real revenue, reportedly raking in 46 crores in FY24, a number that had quadrupled since the last year. Their Bengaluru headquarters swelled to nearly 300 employees. They were winning awards. They were on the top startups lists. Aditya and Sankalp were the golden boys of the embedded finance wave. But while Niro was scaling to unprecedented heights these past few years, the RBI was quietly, methodically rewriting the rulebook. It was a high-stakes race, and Niro was moving at top speed. But in the Indian financial system, the house always wins. Act 3. The Crack. So far, we've only looked at one half of the story. The other half takes you through India's regulatory environment and embedded lending landscape. And in this half, the protagonist is the Reserve Bank of India. This towering institution does not care about algorithms, APIs, or venture capital valuations. Their primary mandate is to protect the stability of the Indian economy. They are the antithesis of the "move fast and break things" motto. Because when you break things in banking, entire economies collapse. These past few years, the RBI had been watching the fintech explosion with growing alarm. They saw the same data Niro saw, but they didn't see democratized credit. They saw a massive, uncontrolled bubble of unsecured debt. They saw millions of loans being handed out like candy on platforms that had no business being banks. They saw the systemic risk of this invisible, frictionless debt. And so the RBI decided to act. They didn't pass a new law banning embedded finance. They did something much quieter, much more technical, and infinitely much more devastating, dramatically changing India's regulatory approach to digital lending. This created significant headwinds for the embedded finance startup. The initial digital lending framework came out in September 2022, establishing rules for loan service providers and issuing legally binding directions addressing consumer protection, transparency, and data security. This was expected. The first real challenge came in 2023. At that point, Indian consumer lending was experiencing significant deterioration in credit quality as personal loan delinquency rates were spiking, and naturally, RBI was worried. So the onslaught of tightening policies began in June, with RBI capping default loss guarantee cover at 5%. Now, DLG cover is the insurance or guarantee that lenders purchase to mitigate loan default risk. This restriction fundamentally changed lending economics. Previously, some lenders relied on this coverage to support aggressive lending to less creditworthy borrowers. Now, with this cap, lenders became more risk-averse, reducing credit availability and increasing lending standards. For platforms like Niro, serving consumers with limited credit history, this meant fewer lenders were willing to participate in riskier segments. The real hammer dropped in November, when RBI raised the risk weight on unsecured consumer loans from 100% to 125%. In banking, risk weight is a rule that dictates how much of a bank's own money must be locked away in a vault as a safety net when they give out a loan. It was the standard cost of doing business. Overnight, the banks that were pouring cash into Niro's API pipes had to lock up significantly more of their own money just to keep doing it. Suddenly, lending became much more expensive for the banks. And to cover this new cost, they had to raise their interest rates. And if loans suddenly became massively expensive, for Niro it meant consumers would stop clicking their button. The second challenge came from a prohibition on loan dispersal through third-party accounts. The April 2024 directive from RBI required all fund flows to occur directly between regulated lender and consumer, eliminating operational efficiencies and directly undermining embedded workflows. Since Niro relied on some level of third-party facilitation, this created a critical operational challenge, one that could be solved by diluting the core value proposition, a frictionless experience. Beyond regulatory headwinds, the competitive landscape had evolved, with many platforms building in-house capabilities and traditional players like HDFC and ICICI Bank entering the embedded space. With all these issues creeping up, investors became more cautious with their money. In fact, the increased regulatory risks attached to the digital lending sector resulted in VC investments plummeting by nearly 50%. Niro was unable to raise additional capital after their latest round in May 2024. This meant they had around a year of runway and an uncertain future. And by late 2024, early 25, the catastrophic forces converged, making way for the perfect storm. Act 4. The Fade. Niro's operations had become untenable, so finally, in October 2025, the APIs were disconnected. The shiny button had disappeared, and the last email was sent out. Niro had shut down. Aditya Kumar took to LinkedIn to acknowledge the resounding defeat, as he said,
$20 million in funding, $200 million in loan disbursements, 30 partnerships, and 4.5 years later, we had to shut down Niro. The last few months have been eventful and challenging, with a perfect storm of regulatory pushback, credit deterioration, and some optimal capitalization. Despite scouring the globe for capital and the country for suitors. I wasn't able to bring this one home.
It was a stark, sobering end to a company that promised to rewrite the rules of money. So what are the lessons buried in the wreckage of Niro? Let's break it down into the cold, hard truths. Niro's decision to position itself as a loan service provider rather than building as a regulated entity was economically rational. But this positioning is what created singular regulatory risk, which was ultimately the driver for its failure. In the financial sector, regulatory walls can go up suddenly. The RBI's decision to tighten digital lending guidelines was a macroprudential measure to protect systemic stability. Niro's failure highlights that venture-backed fintechs must factor these sudden shocks into their survival models. Compliance and agility in the face of new walls are just as critical as product-market fit. Also, operating strictly as an intermediary carries an inherent structural risk. Since Niro built an exceptionally strong API bridge between consumer internet platforms and banking institutions, it did not control its own balance sheet. Unlike a fully regulated entity, it was entirely dependent on the risk appetite of its banking partners. When those partners were forced to tighten their underwriting standards due to external pressures, Niro's origination volume stalled, and they had no proprietary capital to deploy to keep the business moving. Another critical lesson is how quickly venture capital can evaporate when the foundational variables of a business model are disrupted. Venture capital operates on exponential growth models. The moment customer acquisition slowed down and the path to scaling became obscured by macro policy shifts, investor funding dried up for Niro. Without a continuous influx of capital to sustain operations during this transitional period, shutting down became the most responsible fiduciary decision. And the ultimate lesson is that in the lending space, technology is secondary to the credit cycle. It doesn't matter how beautifully designed the button is or how fast the API responds. A brilliant tech stack cannot save a business when the broader macroeconomic environment restricts the flow of capital and the fundamental availability of credit. You can have the best APIs in the world, but if the foundation is built on unsecured debt in a tightening market, the future of finance can disappear overnight. So here's a final thought for you. Is your business a solution, or is it just exploiting a loophole? Because the RBI is right around the corner to cement the gap. And that's your statement for the week. No hidden charges, just hard lessons. If you enjoyed this breakdown, make sure you're subscribed to The Flop Side so you don't miss what's coming next. But before we close this account, here's one last credit for your brain. 95% of India's population doesn't own a credit card, which is exactly why the buy now, pay later model exploded. It filled a massive credit gap. If you've got an interesting take on anything to do with the startup world, or even an unpaid tab, find us on Instagram at 𝗧𝗵𝗲𝗙𝗹𝒻𝗲. I'm your host Priyanka, and I'm here with my co-creator Nandita. Thanks for hanging out with us this week on The Flop Side, where we show you the flip side of flop startups.